From an investing perspective, I'm glad to see the back of 2022. A correction for growth stocks was due, however, it's been much more severe than expected, flooring even Netflix, Facebook and ARK by over 80%. In the same way that growth stocks are hit hardest during bear markets, they are the first out and fastest to rise when bull markets begin. So here's a quick recap of 5 stocks that I've loaded up on, including one that I think can rise 15 times from these levels. First up is Netflix. The stock dropped as much as 80% after user growth stalled early in 2022. Another issue for Netflix has been currency headwinds, because 60% of Netflix's revenue comes outside of the US, and when converted to the outperforming US dollar, Netflix is deducting around $800 million in revenue this year. So what's the plan? Netflix is taking this slowdown in user growth seriously. In a bid to fuel further growth, they've decided to roll out a cheaper ad-supported membership for those with less expendable income, and the company does expect this to add an additional 40 million subscribers. Early signs of adoption for this ad-supported tier doesn't look great. However, it's very early days, and analysts do believe it should be a multi-billion-dollar revenue stream by 2025. Netflix is also making huge movements in the gaming space, having recently acquired 6 gaming studios and partnering with video game giant Ubisoft to create upcoming mobile games, including a sequel to the very successful Assassin's Creed franchise. So what's to come? Well, on the majority of metrics, Netflix and the streaming industry do appear to be doing great. Netflix's costs seem relatively under control, they have a growing library of IP that could one day rival Disney, price increases are proving successful, and if you chuck in advertising revenue, a gaming division, and the upcoming crackdown on password sharing, then I do expect Netflix to continue growing users, revenue, and earnings for many years to come. Next up is the Uber of Southeast Asia, aka Grab. The stock has been battered as revenues dropped horrifically during lockdown, and given how unprofitable Grab has been at the best of times, analysts have feared the worst. Fortunately, Grab's food delivery business was a lifeline throughout the lockdowns. Revenue in that segment grew 250% year over year and turned a profit for the first time in a decade, and this taste of maturity has taken over at the company, who have now diverted from growth for all costs and instead are focused on becoming profitable by 2024. This means charging customers more, reducing driver incentives, and slowing headcount growth, and because of this, the company has warned investors that revenue growth should be expected to slow from the triple-figure growth they've been used to. So what's to come? Well, the big question is, how much will Grab's revenue growth suffer from these price hikes and cost-cutting procedures? Most investors clearly didn't want to hang around to find out, and selling has pushed the stock down as low as 85%. Yet Grab showed hugely encouraging signs when reporting earnings this quarter. Losses narrowed by 24%, yet they also posted a company record for sales and raised annual revenue guidance to 55%. This is less than the 77% growth that investors had forecast before Grab's pivot towards profitability. However, it's nowhere near as bad as feared, and when considering that travel to Southeast Asia is still not even 30% of pre-COVID levels, Grab should have no trouble at all continuing to grow revenue alongside reaching profitability. Third on this list is Unity Software. The stock was due a pullback after a 300% post-IPO rally. However, the correction has been sharper than expected thanks to a tougher economy, combined with personal issues such as cash burn, share dilutive acquisitions, and a recently botched product launch. Despite the huge change in valuation for Unity, the company and its trajectory remain very much the same. The company has a dominant market share within video game development, with their tools being used to create over 70% of mobile games. Unity's gaming market share may have reached maturity, but providing they can slowly increase prices, reduce costs, and expand their ecosystem of tools, then the company could well benefit from the growth of the gaming industry more than anybody. Most excitingly though, the company continues to tap into other diverse industries such as metaverse, entertainment, automotive, and film, having recently struck deals with Hyundai to build a 3D car factory, as well as supporting with animation on recent hit movies Wakanda Forever and Avatar 2. The business clearly feels that it can transcend into a much larger and more integral software giant, given its recent decision to turn down an 18 to 20 billion takeover offer from AppLovin. And given Unity is currently valued at just 12 billion, means management at Unity believe the company is worth a lot more than the 50% premium at where it trades today. My other joint largest investment is Tencent Music, otherwise known as TME. This is the music streaming leader in China, and its stock has been hammered along with most other Chinese stocks due to excessive national lockdowns, tighter regulations, and anti-competitive lawsuits. TME was recently forced to give up their licensing agreements with global music labels, as it essentially gave them a monopoly on the Chinese streaming market. This has increased competition. However, a silver lining is that these licensing deals were extremely expensive, and therefore TME will be saving a lot of money. This is quite timely given that TME is reaching maturity in the Chinese market and has begun to focus on increasing earnings and becoming profitable. Early signs have been excellent, with the company growing earnings 35% in 2022 while seeing no slowdown in new subscribers. The company now has 85 million users and has overtaken Amazon Music as the third largest global streaming platform behind Spotify and Apple. Unlike their Western counterparts, competition is much less fierce in the Asian streaming market, and that's allowing TME to achieve the strongest margins and earnings in the industry. The company is now focused on replicating its local success across the rest of Southeast Asia and is doing a great job, so far commanding over 50% of the streaming market in Thailand and Malaysia. Last but not least is British online fashion retailer ASOS. After a brutal post-lockdown correction in ASOS' share price, I'm starting to think that one day I'll be the majority shareholder. Tough year-over-year financial comparisons, supply chain issues, a looming recession, high debt not helped by rising interest rates, and societal concerns about fast fashion truly have this company on the ropes. Did you know fast fashion is the second biggest consumer of water and responsible for 10% of all carbon emissions? Anyway, after a successful debt restructuring, the company looks safe for now. It's surprising that bankruptcy was even on the cards for a business turning over $5 billion in annual revenue, but the new CEO has made clear that ASOS will have a more streamlined growth strategy going forward. This cost-saving strategy involves moving away from a high-volume, heavily discounted model and intends to scale back its global expansion plans to focus on the UK, France, Germany and the US. Right now, the stock is ridiculously cheap, trading at a price-to-sales ratio of just 0.11. ASOS' average price to sales ratio over the past 5 years is about 15 times, and therefore, although risky, I do think the stock offers enormous upside potential. There you go, 5 stocks that I'm buying and holding right now. Remember, I'm not a financial advisor and this is not financial advice, but if you did find it useful in any way, please do click the like button, subscribe, and remember that your money should be working for you and not the other way around.